The opinions expressed on Two-Way Traffic are those of Darren Coleman and are for general information purposes only. It does not constitute any legally binding engagement between the podcasters and anyone else. Always check with your advisors to obtain your own tax or investment advice. Welcome to Two-Way Traffic with Darren Coleman. In this series, Darren aims to guide you through the complexities, complications, implications, and most importantly, the advantages of having money and family on both sides of the border. In this episode, Starlight Capital's CEO Dennis Mitchell joins Darren to talk about how dealing with Trump won't be easy, but how it may offer opportunities for Canada and investors.
All right. Hi, everyone, and welcome back to another edition of Two-Way Traffic, the podcast. And today I'm delighted to be joined by my longtime friend, Dennis Mitchell. Dennis is the CEO and Chief Investment Officer for Starlight Capital in Etobicoke, Ontario. He's been a fixture of the Canadian investment and U.S. investment landscape for a long time. He's regularly on much more popular shows than this one on BNN and CNBC and other things. You've been a longtime successful investor in North America. You've won a number of Top Gun awards from Brennan Wood International. And most importantly, besides all these things, is you're my friend. So Dennis, thank you and welcome to the podcast today.
Thanks, Darren. And I truly value our friendship over the last too many decades, we'll say.
Although you're moving to a new house and you won't let me get you a housewarming gift. You're not going to tell me where you live. I don't know why. You know I'll pop in.
I'll give you a list of charities you can make a donation to.
I already do that, so we'll add to the list. Well, listen, today, speaking of charities, we're going to talk about Canada. And and what we do. I mean, I'm not entirely sure when this is going to go to air, but I imagine the things we're talking about will still be in motion. I don't think much is going to get resolved in the short term. But we're dealing with this kind of tariff tantrum, the Trump tariff tantrum. Look at me go. We've had a lot of concern, not just in Canada, but globally, is President Trump is using tariffs as a bit of a stick to get his policy decisions implemented. And I think Canadians might be vibrating to discover that President Trump is not our president. And we are two different countries, and we were being reminded that we may have diverging interests. So I wanted to talk today a little bit about what your impression as a very successful investment manager is. How much should we be worrying about this? What action maybe are you taking, or should investors be thinking about taking? So I'll just open it there and maybe get your initial thoughts and comments on kind of where are we right now and what should we be focused on?
Right. So I think with Trump, a number of people over the years have said that you have to take him seriously, but not literally. And I think that's great advice for markets as well. So I think two ways to evaluate Trump's impact on markets. The first is longer term, what can you expect versus the trajectory we were on before. So longer term, what you can expect is less regulation. You can expect, more growth. You can expect a focus on sort of manufacturing domestically, right? Increasing that, driving more foreign investment into the United States. And you can expect, a focus more on fossil fuels and less on renewable energy. These are some of the, and you can expect more deficit spending, and you can expect more volatility with that as well.
Yep.
So that's sort of the longer term playbook, if you will. And so an investment strategy, to the extent that you need to tweak it, should be tweaked along those longer term trends. In the short term, you have to ask yourself, how does Trump usually operate? To put it charitably, he operates chaotically, right? So
kind of comes in, kicks over all the furniture, and then says he's the victim. I get it.
Exactly. So I think you have to use the volatility that he creates around things like seizing the Panama Canal and, acquiring Greenland and turning Gaza into a resort and implementing tariffs against allies. I think you have to use the volatility of those announcements and those actions to invest along your long-term trajectory, right? Because long-term, we should all be investing in high-quality businesses that are driving, free cash flow growth. And so to the extent that Trump volatility creates a sell-off in any of those types of companies, that's where you should be allocating your capital at that time to capture those outsized returns that his, chaos and volatility creates.
Yeah, you're right. I think we do have to learn to look through the noise. I feel like many people have not read The Art of the Deal, where he kind of gives a little bit of a guidebook to the way he's going to play the game. And it might be a little too early to pick definite winners and losers, although I would argue that I saw there was a directive about banning plastic or paper straws. So if you're in the paper straw business, you might be in trouble. And personally, I'm quite happy about that because I find them to be not very effective. So absent the paper straw industry, there are certain winners and losers, at least now, that maybe we can begin to suspect. So things, for example, like, hybrid cars or electric cars, which is interesting. I don't know if that's going to be, you got Tesla there, the head of Tesla in charge, but it looks like some of the subsidies and things might be going away. It looks like they're on a real mission to eliminate a lot of government spending, which makes sense given the size of the debt. So is there a way that we can kind of initially anyway, go certain industries right now maybe are worthy of attention? And you're right, characteristics of the style of business make sense. But are there certain industries right now that you're like, actually, I'd probably be more interested in those, maybe less interested in these?
Yeah, I think just based on not just Trump, but also who he's put in cabinet, I think you can look at energy, traditional fossil fuel energy industry as being an area that's going to be attractive going forward during his administration. Clearly technology, what do you want to call them? The tech oligarchs have all lined up, not just at his inauguration, but they've all lined up to pay fealty to Trump and to work with him. And then I think you have to look at anything that's being manufactured outside of the United States that could conceivably shift to the United States. And I say conceivably because I think a lot of people are concerned about the auto industry in Canada. It would take decades to replicate the supply chain of southwestern Ontario within, continental United States. So that is not, an industry that I think investors in the short and intermediate term have to worry about in terms of, replication and capital flowing outside of the country and into the U.S. to replicate that infrastructure.
No, that's fair.
And I think, I mentioned his cabinet. RFK Jr. Taking over Health and Human Services, that is of concern for healthcare businesses, right? You have to think that there'll be continued pressure, downward pressure on sort of drug costs. There'll be increased review and oversight and downright skepticism around some of the treatments that exist out there, whether it's women's reproductive health, vaccines, even the vaccines that Trump himself spearheaded and created for COVID-19. You have to be concerned about sort of increased oversight and questioning and potential outright bans of some of these industries and some of these treatments and technologies based on who Trump has put in various cabinets. But I think technology specifically and energy specifically are two areas that I think will benefit from a Trump administration. And again, not just outright, but then compare it to the previous administration, right? The previous administration was very focused on renewable energy. Right. The previous administration was not necessarily a big fan and partner of the tech oligarchy. And so it's not just absolute, but it's also relative to where we've come from.
So let's spend some time on each of those two industries, because the outcome for Canadians and investors is going to be interesting between the two of them. So on the energy side, you're right. He, in his first day, he said, "Drill, baby, drill" in his speech. So that was pretty clear that, the fossil fuels are going to be around for a long time. And he's signing agreements with places like Japan for liquid natural gas that Canada had a shot at those agreements, and we decided not to. So if we're going to see a focus on the energy sector, is that good for American energy companies, or is it also positive for Canadian energy companies?
I think it's good for both.
Is it? Okay.
Yeah, and the simple reason is that the demand for energy in the United States in particular is almost insatiable and will not be met without significant investment on both sides of the border. So if we take a step back, the energy industry, the traditional fossil fuel energy industry in North America has gone through a significant restructuring over the last 20 years. Mm-hmm. So gone are the days where guys are going door to door and raising capital to drill hopes and dream holes all over the place, right?
Moose pasture mines, that kind of thing, right? The new issues for those things.
Exactly, right? And so, that was an exercise in destroying capital, in, delivering negative long-term returns, and no one benefited from that.
Right.
The industry is restructured around, being sustainable producers, being more efficient producers and returning capital to equity investors. Go figure, right? And so that has resulted in, more stable and consistent capital flowing into the industry and more stable and consistent returns flowing out of the industry. And so anything that then sort of creates more and more demand for power, for energy, is a plus. So what have we seen recently? We've seen Stargate, right? So that's OpenAI, that is SoftBank, that's Oracle, announcing that they're going to invest 500 billion to develop data centers across the United States. And what do data centers need? Power, right? Over the next 20 years, you are going to see, to support AI development, you're going to see data centers built that will require as much power as the United States is currently producing.
Wow.
So whether it's fossil fuels, renewable energy, or technologies that are under development now, the energy space is going to be the recipient of a significant amount of capital investment. And it's my hope that they maintain enough discipline that the returns that come out of the industry will reward that capital investment. And we haven't even talked about Microsoft. Microsoft is like, look, we're going to spend 85 billion over the next year on data center build out. So the demands for power across North America are going to be significant. And again, the United States will not be able to satisfy all of this demand. They're going to need Canadian energy as well. So that's, again, comes back to the original point that I made. Use the volatility that his style creates to invest longer term in the trends that he supports.
No, I think that's perfect advice, because I think people are getting very caught up in the short term of which way is the ball bouncing right now. And we have to be reminded of looking down the road to where is all this probably headed. And the noise as he tries to find his parking space is maybe not what we should be focused on. Although that's what the press certainly wants us to think about every minute. Now, let's pivot a second to how Canada is going to respond to this, because the energy sector longer term trends are looking good. But if we've got tariffs on our energy and other things, how do we want to navigate that? Or is that in the space of that's just noise in the short term?
The biggest challenge we have in this country specifically, and this may surprise you, it's interprovincial trade barriers, right? So official ones which limit sort of trade between provinces, but it's also negotiated barriers. So for instance, Alberta has tried unsuccessfully to partner with Quebec to send energy out east, right, to export markets other than the United States. And they've tried unsuccessfully to negotiate with First Nations and BC to send energy north and west to get it out of this country.
It's all going south. So we have one customer.
Exactly. And so what I actually look at sort of the tariffs and sort of the volatility that he's creating as another opportunity for Canada to figure this out. Because the global energy market, like take everything that I just said about Canada and the United States demand for power and multiply it by a couple of times, and that gives you China's demand for power, India's demand for power, and the ECB's demand for power. So we have what the world needs. We're talking oil and gas, but you can expand that to nickel, rare earth minerals, water, gold, the list goes on. We should take this as an opportunity to diversify our export markets, diversify our trade relationships, and grow wealth within this country. And heck, I would even say with energy, let's find a way to make stuff with it in this country and export it to other countries as well. So it's not just raw materials we should be looking at exporting. We should take this as an opportunity to attract foreign investment in this country, to make high value goods within this country, to create more wealth by exporting higher value items out to other countries other than the US. I think that's the way to win long-term a trade war with the United States. We won't win in the short term. We just can't. The law of large numbers is against us. But longer term, using this as an opportunity to diversify, I think that's how you win longer term.
I feel like that's been an argument we've been hearing since the 70s, though, right? Canada seems to, it's this land of promise and opportunity, but it's also unfulfilled opportunity as well, right? And the data center thing you mentioned is interesting. I'm going to echo Kevin O'Leary a little bit, saying like that's a massive opportunity set for Canada, because we could pop, we've got the cheaper energy, we have abundance of energy. We could pop data centers all the way along our borders to support the United States and keep that business, keep that revenue, keep those opportunities for jobs in Canada. But I don't see any politicians talking about this at the moment as an opportunity set for us.
Yeah, and to be fair, I'm not sure that there are a ton of politicians in this country that actually understand that. I think, and to further be fair, I'm not sure there are a lot of politicians in this country right now that are thinking about anything other than the Liberal leadership race and the eventual election later this year, right?
Yeah.
So
it seems like maybe the wrong focus at this time. And I'm not even sure, we know when we're going to have a functioning government that has a mandate in Canada for months. So this is maybe not the time for, no one to be at the front of the ship, or at least the person who is may not have the rest of the people behind them fully.
Yeah. Well, what I would say is that fortunately for us, in terms of investment in data centers, it doesn't really require sort of participation from the federal government.
Right.
You're more talking about, okay, who are the large consumers of space at data centers? And so, telecom firms are your obvious example. But expanding beyond that, any large Canadian company. So you've got energy firms, financial services firms, including banks and insurance companies. You've got healthcare companies. These are all potential large hyperscale users of data centers. And that's just talking about Canadian companies. You can expand that thought into very large multinational corporations, right? So last time I checked, people still use Twitter or X in Canada. They still used Facebook, Instagram, Microsoft, 365. All of these large technology companies still have a presence in Canada and require local sort of servers and data center utilization. So it doesn't necessarily require sort of top-down leadership from the federal government. It's more recognition from people who would actually construct these data centers that there's an opportunity here if they can partner and create sort of the opportunities for themselves. One other thing I would say is that this is a good segue into the real estate space. Yep. Darren, what you're seeing is a lot of industrial landlords, like a Dream Industrial, Granite, like a Prologis, GMG Group out of Australia. A lot of them are embarking on programs to convert warehouse assets into data center assets. And I'll give you an example.
That's interesting.
Goodman Group out of Australia, GMG, as a sort of pilot project, spent $300 million converting one of their warehouses into a data center. They then sold it for over $700 million.
Wow.
Yeah. So they estimate that they could do 20 of these conversions a year for the next 5 years. That is massive. You have Prologis.
And that's without really having to put another shovel in the ground. They're just converting existing assets they have, repurposing them.
So when you look at your major costs for a development, land is the major cost. Yeah. Well, if you already own the land and the shell, you're saving immensely on sort of the development costs. You're also cutting down on the time, right? So it's no longer about zoning and permitting. It's no longer about zoning. You can pivot to just the permitting process for the changes you want to make to the existing asset.
Right.
So you look at a company like Prologis, the largest industrial landlord in the world with 1 billion square feet in 19 countries. They estimate that they've got at least 100 assets around the world that they could convert from warehouses to data centers. Segro is undertaking this. They're the largest pan-European data center industrial landlord. And then you've got the Canadian REITs like Dream and Granite who have similar opportunities in their portfolio. So, in terms of sort of the build out and all of this investment that you're hearing, somebody's got to build the actual infrastructure to support all of this investment. And so I think the industrial real estate space, in addition to data center REITs, are the natural beneficiaries of all of this capital investment.
So the business case is obviously there. I think going back to what the federal government can do is make just kind of grease the wheels, as it were, for that to happen in greater volume. So some of the things that maybe have inhibited that a little bit have been questions around what is our tax policy, like what is the capital gains rate going to be. So I think messing with some of those things has created, or have you seen it create a little more uncertainty about, is there more capital coming into Canada? Because I think that those are the things the federal government can control about making us more attractive to foreign investors that want to invest here. But if you start messing with what the eventual capital gains tax rates are, that may make capital not want to come here, as one example. And what our currency is doing is being also a problem for us, but maybe that makes us more attractive to those foreign investors.
Yeah, and so both of those are interesting dynamics. So the potential increase in the inclusion for capital gains taxation has been deferred now until next year. So that's basically a nice way of saying that none of the leading candidates support this, and so we'll defer the implementation until these guys can come in, get settled, and kill it formally. So that does create a little indigestion and volatility in the short term. But again, it goes hand in hand with use the volatility in the short term to invest longer term along the trends. You mentioned currency. Absolutely. Investing in Canadian equities or Canadian assets in general has become 15, 20% more attractive and cheaper for anybody bringing US dollars into the Canadian market in particular, but also to a lesser extent, euros into the Canadian economy as well. So, again, the shorter term volatility of the sell-off in CAD creates longer term returns that you can benefit from.
So use those things. I guess what I'm getting at is that some of the uncertainty around things that the federal government can control, like tax policy, which would include things like carbon tax, because companies need visibility on their cost of capital. And those are two really important items that will hit their income statement. And they're not entirely sure how to factor those in. So I think if they have clarity on those, and those two issues get minimized, maybe we will see more money coming in, taking advantage of that lower dollar. I want to move also, there's two other sectors I want to talk about that have come up recently. One is technology we'll talk about. But before, I want to leave that one to the end because I think that's actually a really interesting one. But one that seemed to be a little bit of a surprise was when President Trump mentioned about Canadian banks. They don't let the American banks come up here. So we've had a really good oligopoly in Canada for the banks and bank investors, maybe not for customers. And we can look at 2008 and say maybe that oligopoly kind of and that conservatism may have protected us. But do you think that might be an area where Trump, he may have just said it, or do you think that might be another policy issue that we need to pay attention to as our Canadian banking sector and maybe getting more competition?
Yeah, and I think, again, with Trump, you have to deal with the fact that he says stuff, but then if it gets traction, then he tends to gravitate and focus on it. In fact, I think that might explain his entire first administration, right? He said he was going to run for president, and then he got traction, and he actually became president. But I digress. Coming back to the Canadian banks, I think he comes at it from a guy who's borrowed enormous sums of money from banking institutions.
He's taken a lot of pens from a lot of desks. Yeah.
Right, exactly. So I think he comes at it from that perspective, and I think he looks at sort of the closed loop that is the Canadian banking system. And let's be fair, there are a number of U.S. banks that are here and have been here a number of times, right? Merrill Lynch has been here and is currently here. Morgan Stanley is talking about coming here. JP Morgan is here. And so the list goes, Wells Fargo is here.
Yeah, they're coming in. They just don't have the same ability to compete on, for example, tier one or schedule one banking. You're not seeing a JP Morgan show up that'll open a bank account for you, for example.
Yeah, and to be fair, I'm not sure that, there's two ways to do that for them. They come in and they spend decades building out infrastructure to compete, not really an attractive proposition. Yeah. Or two, they buy a Canadian bank, which is unlikely to be allowed to happen because that would almost overnight result in the externalization of all of our banking. Like, I don't think it's a stretch to say that banks are a strategic national asset that should remain Canadian owned, or majority Canadian owned, and certainly Canadian regulated and controlled. So I don't see that as a longer term threat or something that we have to be concerned about. Now, having said that, I would love for there to be a little more aggressive competition in the Canadian banking sector. That I think would unleash a lot of innovation and a lot of productivity growth in the Canadian economy. So anything that sort of decentralizes some of that asset and wealth management capability, I think would be a benefit for productivity and innovation in this country.
Yeah, well, you and I are big fans of that competition model and meritocracy, so we would be supportive of it. So I guess what I'm going to take from that is we kind of can maybe look at his comments about the banking in Canada as maybe a trial balloon. And you're right, if it gets traction, maybe we see more, but if it doesn't get any traction, maybe well, I think one of the interesting things is that he's done so many directives. This is such a different presidency than his first one, where I think he was shocked he got in the first time. And it was maybe kind of chaotic. Nobody knew where to stand. I think the organization, anyway, for better or worse, has been remarkable. They've come in with a mission, and in the first 2 days, he did like 100+ presidential directives. Just like they came in with a game plan, and they're fighting on lots of fronts now. So I think if anything gets traction, they'll run with it. But if it doesn't, hey, I got 5 more ideas I'm still working on. So there's a lot of speed with this. So we'll see what they might go with or might trip over. Let's move to technology, because I agree with you. It was interesting watching, all the tech bros lining up at the inauguration with their billions of dollars, some of whom do not get along, but they're all recognizing we better support the new sheriff in town. But along with, we can kind of see the trend that obviously more technology is going to keep being a positive, but valuation, I think, is a real concern for investors. We've seen such a concentration of wealth in the S&P 500, for example, where less than 10 stocks dominate most of the market performance, and investors just keep piling into the same names. And even though the business might be great, the price they're paying for it might really be a huge stretch. And a little shock to the system can create a huge effect of the stock price. NVIDIA gave us a great example of this, a short while ago when, DeepSeek, this Chinese competitor, just kind of showed up. And in a day, NVIDIA lost 18% of its value because it's at such a high point. So how do investors kind of approach this saying, yeah, we get the idea, but it seems like it's a really crowded trade. Do I keep just going with the leaders and price isn't an option? Because as Canadians, we kind of saw this movie in 2000 with JDS Uniphase and Nortel. So maybe some of us are having a bit of an emotional disturbance about, we kind of saw how that ended. How should investors approach this?
Well, I do think it's interesting that, I remember, I'm old enough to remember when Nortel was 33% of the TSX, right? And everybody chided the TSX for being an inefficient benchmark. But now you fast forward to 2025, the Mag 7 are over 30% of the S&P 500 and over 28% of the Russell 3000.
Wow. Yeah, exactly. So we're kind of old. Everything old is new again, right?
Yeah. And well, it's proof that, a next generation is doomed to repeat the mistakes of previous generations, which doesn't bode well for the survival of the species. But fortunately, neither of us will be around to see that, I don't think.
Come on, you're much older than I am, please. I should think it's the other way around, but anyway.
But coming back to sort of technology, so I think technology and healthcare are the two global sectors where you see the lion's share of innovation, right? And two sectors where you see the lion's share of capital investment as well, because there's no growth without investment. I think what you're seeing out of the tech response is that, they've got an administration that, one, is aligned with them. Like Trump loves to hang out with people who are also really, really rich. So that's a check. And two, compared to the previous administration, he shows almost no interest in regulating them beyond making sure that they don't censor conservative, viewpoints and speakers.
Yes.
So I think they see that, and you're seeing the fallout, right? I mean, you've got fact-checking declining, entire fact-checking teams being fired. You're seeing the reinstatement of controversial people on social media. So I think technology sees this as, a 4-year period where they have almost carte blanche to do whatever they would like to drive investment, to drive growth. And, they've figured out, as much as Trump has figured out the job, from his previous administration, and he's come in with a plan, the market has figured Trump out, right? And so a lot of these tech CEOs and oligarchs have figured him out. Yeah. So they know that they have to flatter him. They know that they have to present their ideas and their plans in the context of what would make him look good, right? So, famously, the SoftBank guy said, Trump, you asked, I told you I was going to do $100 billion of investment. You asked for $200 billion, and I've come back with $500 billion, right?
Yes, and he looks like a superstar, right? Yes.
Exactly. So people have figured him out as well, for better or for worse, right?
I wish Team Canada would take some cues from this. I think going in and wanting to go toe-to-toe is not the right strategy. I've told a few people, I think what we should have done when he talked about tariffs to Canada is gone down and said, Mr. Trump, you're a handsome gentleman. Congratulations on the win. We love your bigly hands. You're a hell of a golfer. You know what? You're right. We can probably do a bit of work together on the border. There's stuff, you're worried about fentanyl. We're worried about these things called guns. You've heard of those. There's a few things we can probably work together on. And you're right. Our military, we haven't lived up to our commitments. Is there a salesperson from Lockheed Martin or Raytheon we could maybe talk to and buy some submarines and things? I think he would have just said, you guys get the message and moved on. And he would have chalked up a win and left us alone. I don't think going toe to toe was maybe the right approach with him.
Well, I think you're on the right path, but remember, he needs to actually win a fight.
Sure.
So as much as that is the winning strategy, he needs to actually implement tariffs. And then he needs you to announce that you're doing his bidding so that he can say, as a result of them capitulating and rolling over, I am eliminating the tariffs. That's what happened 8 years ago.
Yeah.
He needs to actually have the fight so that he can declare victory and then, move on to the next battle to win.
Well, I think Canada can get some wins out of this, right? We talked before, and I think actually, even though it's chaos a little bit, he is a huge catalyst for change if we embrace it properly. You mentioned right at the beginning, we've got enormous interprovincial trade barriers that have existed for generations. Well, we need to get rid of those. Like our best trading partner are the other provinces. So I think if we in Canada, if we can use this catalyst for change to affect a positive change and actually address some of these policies, now that there's this external force, we may wind up with a vastly better economy. It just took that firecracker to make us act, right?
Exactly. And so again, I think this is yet another opportunity to take a crack at diversifying the domestic economy, but also diversifying our trading relationships and partnerships globally. So to your point, we've swung and missed at this a number of times, and sometimes we haven't even shown up to take our place in the batter's box. We're in the midst of that opportunity right this second. So hopefully,
I feel like right now we're all in the parking lot trying to figure out what jersey we're going to wear.
Yeah, and so look, I think there's a tremendous opportunity here. I think we can narrow the candidates for prime minister down to two people, Pierre Poilievre and Mark Carney. And I think
you're not betting on Christia, right? I don't want to count her out. I'm a big fan of her.
Listen, 40 of her colleagues have sided with Mark Carney, so it's hard to overcome that.
Don't you think we should just get that done and we can move on? I can't believe this is going to be another month and two debates and things. This just seems like a long time.
There's this thing called democracy, and we kind of swore that we would abide by it a couple hundred years ago. So, it gets...
You're such a rule stickler.
Yeah, it gets kind of squeaky and annoying at times, but it also kind of works longer term. So, there's a process to everything.
Yeah.
So eventually, hopefully you'll knock on wood, you end up with Carney versus Poilievre. And I think broadly, both of them are sort of free market operators.
Yeah.
I think Poilievre probably strikes a better relationship with Trump right out of the gate. But I think longer term, I think Carney is probably the better option for Canada, just from the standpoint of here's a person who understands global markets, has got a platform and a profile globally, is used to sort of building consensus, having run two of the big 7 central banks on the planet. I just think either candidate is probably going to have a good opportunity to do a lot of things to diversify the Canadian economy and build, trading relationships outside of the U.S. And then it's just a question of execution.
Okay, that's a good overview of the two candidates. I am maybe not as big a fan of one of them as you mentioned, so I won't tell you who. But anyway, so we'll see how this unfolds. Let's go back to the tech thing for a minute, because
Sure.
I think one of the things that's interesting in there, and I see you do it in your portfolios, is we can see the main theme of, yes, more technology, but instead of betting on the same ones, I just see people putting money in the same slot machines, right? They're just buying the Magnificent Seven. Every time they buy the S&P 500, more credits go into the machine for the Magnificent Seven. And I think looking at, what are other areas that will benefit without maybe buying the most expensive stock in the room? So this is where things like data centers, right? If that trend's going to continue. So in our one of our models that Christian and I are working on is this idea of bank shots. Like when you play pool, you can see your ball and the other ball, but maybe I want to get there by banking it off the rail or hitting another ball into that ball. So what are the trends that exist and how can I profit from them maybe in a slightly different way? So yes, I want tech and energy, but maybe I'll do it through the data center and the energy that funds data centers. Are there other bank shot ideas like that you say that, for example, real estate is a place that manifests that?
Yeah, and I mean, we talked about industrial real estate, right? And shifting over to provide more data centers and capacity. But taking a step back, when we talk about sort of the gold rush in San Francisco, back in 49, right? Ironically, how the 49ers got their nickname. But
so this is the picks and shovels thing, right? We're going for gold, but you didn't a lot of money selling picks and shovels and donkeys to these guys.
So very few people got rich actually panning for gold, right? Yeah. But the people who provided the picks and shovels, they made money regardless of who actually found gold. So extrapolating that out going forward, who's going to win in terms of AI? Who's going to have the best chatbot or whatever? I couldn't tell you. And it's hard to pick a winner when you've got Microsoft versus Oracle versus Google, right? I mean, who's going to win there?
Yeah,
but what I do know is that the guys who provide the infrastructure that allows them to actually wage this battle, they're going to win.
Right.
So data centers is an obvious example. power is an obvious example. But then you start getting into derivatives, right? Like, who are the guys who are actually physically constructing these data centers, right? So all of those guys are going to benefit now. And then when you do have the winners, if you will, those guys will continue to benefit just at a slower pace, right? So if they're benefiting from the fact that these guys are competing and it's a land grab, they're going to earn abnormal returns. But then when, sort of the froth of competition slows and, guys fall off and you have your 2 or 3 champions who win, they're going to continue to compound capital. But, some of the cream is going to come off. Some of the outsized returns are going to come in. And, returns are going to normalize. And for anybody who's invested through 1 or 2 business cycles, they recognize this pattern, right? So I would say you really want to look at who are the guys who provide infrastructure that allows sort of this technology boom. Those are the bank shots, if you will, that are going to pay off in a more consistent manner and with a tighter range of potential outcomes, right? If you're picking the guys at the forefront of the battle for technology, some of them are going to lose, some of them are going to die. But the guys who provide the infrastructure, whoever the winner is, they're going to move over there and continue to compound capital.
Yeah, and this is a great example of, I'll call them amateur investors versus really professional investors. Any amateur investor, and it's been hard because that's been the winning game for the last while, can go out and buy the headline stocks. I can watch Kramer on CNBC and I can buy Apple and Google or Alphabet. I can buy what I see are the winners, and that's where people have been loading up. But the second and third order of who else is going to win, where you can buy the same trend, but at a much lower valuation and get a better long-term return and more diversification. I'd argue that that's where a lot of horsepower on due diligence and taking the time to investigate this is kind of beyond what most individual investors have any capacity or any connections to do. So this is where a team like yours, I think, comes in that can actually do the homework and see these other things unfolding. And maybe the most popular kid at the party is getting all the attention, the NVIDIAs and the Microsofts. But long term, as we've watched in Canada, that can actually be a pretty dangerous party to be part of. So taking that next level down and looking around, which requires work and requires skill and expertise, which I'd argue most investors do not have. Is that a reasonable comparison?
Yeah, and I would use these 2 examples to kind of support that. I think a lot of people, I think the default is that the professional investors are so smart, right? They've got letters after their names and all of that. I would argue that is not only not true, but it's also not a prerequisite.
Right.
Okay. So what I would say is that the advantage that I have as a professional versus somebody who's not a professional investor is, 1, I have the experience, the expertise, and the framework. And 2, I have the access. And so when I say I have the experience and the expertise and the framework, I think a lot of non-professional investors look for stories, right? Yes. Populations are aging. People are, developing markets want to lead a more North American type lifestyle. They look for stories and they'll invest around those stories, but then they don't have the framework to sort of evaluate the story. And by evaluate the story, nobody comes around and tells you a horrible story about an opportunity or a business, right? Nobody comes in and says, this is a terrible business, but you should still allocate capital to it. What's missing is the risk component of it. So a lot of amateur investors, if you will, to use your term, are hyper-focused on the returns and what they could potentially earn, but overlook sort of the risks that they're engaging in to achieve those returns. And I liken it to, I want to beat my brother home, and so I'm going to take a shortcut through the minefield to beat him home. And you might beat him.
Or not.
But you also might take a little more risk to get that outcome than you probably should. And then it's framework. Because I've been doing this for 20 years, I've been through different market cycles. I understand, sort of the interplay between risk and return over a cycle, and I know what to focus on from a risk standpoint and how to evaluate investments appropriately. Even when people get the story right, you may have the company wrong, right? There are a lot of people who understand that, our population is aging, we're living longer, and so the demand for seniors housing is increasing. And I mentioned that because one of my companies reported last night and is having a fantastic day, despite the fact that markets are down. But, just saying that the seniors housing industry looks attractive right now doesn't necessarily mean that every company within there is an attractive investment. if you get the sector right, but the actual company wrong, you're still wrong.
Oh, I agree. I usually sometimes use this example. If you could go back to the mid 80s and said, I think this personal computer thing is going to be a big deal. And you would have said, you know what I'm going to do? I'm going to load up my portfolio on digital equipment, Wang, Commodore, Compaq. All those businesses are gone today. So you had the theme right. But if I go back to 1986, unless you bought Microsoft, you lost all your money. Right?
Exactly.
So you had about one company, yet there were all these competitors and way too early to know winners and losers. So you're exactly right. You can have the theme correct, but if you bought the wrong business or you paid too much for the business, I'd go back and encourage people to look at a chart of Cisco in 1999. If you'd said the internet's going to be a big deal, well, you were more right than you knew. But if you put all of your money into Cisco, you're still not back to where you were in 1999 as a stock price. So shocking what can happen if you pay too much.
And the other piece that I think as a professional investor that I enjoy is access, right? So in any given week, I've got, 3 or 4 CEOs coming through the office to talk to us specifically about their results and their outlook and, their plans for capital allocation. I have access to research from 60 or 70 different shops around the globe. I can go to conferences, I can go to property tours, I can see the physical assets if I need to. And I have access to databases that will give me firsthand industry knowledge and information. So those are the advantages. And it's not so much that, we're super smart. I've met a number of my colleagues that I don't know that I put them in that bucket. And I think if you're giving me money because you think I'm super smart, then I'll take the money still, but you might be a little inaccurate. It really comes down to experience, expertise, framework, and access. Those are the things that I enjoy a competitive advantage against any sort of traditional sort of amateur investor, if you will.
Yeah. Well, I think that's a great way to maybe end our call today. On those are definitely the advantages that I know you bring to investors, and we worked together for a long time, so I know that to be true. And yeah, you're usually the smartest guy in the room everywhere you go, but I can say that. It's not arrogant if you say that. And maybe what I'll do is I'll take advantage of this. It's always good to end on a little bit of a cliffhanger. I think what I'm going to do is ask if you can come back and do another podcast in the future, and maybe zero in on another area of expertise that you have that I think a lot of people would be interested in. Is maybe we just talk about the residential real estate market, both in Canada and the US, and kind of what are the trends there. Is Canadian market overpriced? We're seeing a huge institutionalization of purchases going on in the US housing market. Will we see that in Canada? I think I'll set the table for that being a future conversation, if you don't mind.
Absolutely. And I'll come armed with the stats and the data for you, Darren.
That would be perfect. So listen, Dennis, thank you very much. I think you gave us a really good overview of kind of maybe where we are right now and will be for the next little while. And I think you gave us a pretty good little playbook for how to navigate President Trump in the next while going forward. So with that, thank you very much. I appreciate you joining me. I always appreciate our friendship. I will find out where you live and send you flowers for your new home. I will do that. And listeners, thank you very much for joining us. And we look forward to having Dennis back and having you on another episode of Two-Way Traffic in the future. So thank you very much.
Thanks, Darren. Take care.
This has been Two-Way Traffic with Darren Coleman. Thanks for watching and listening. If you have any questions or comments or ideas for new episodes, send us an email at twowaypodcast@gmail.com. And you can find the Two-Way Traffic podcast on Facebook and Twitter. This series is a production of the Acme Podcasting Company.
On behalf of the Two-Way Traffic podcast and Portage Wealth of Raymond James, thank you for listening to this conversation. This podcast has been prepared by and expressed the opinions of Darren Coleman and his guests and are not necessarily the opinions of Raymond James Ltd. Statistics, data, and other information presented are from sources Raymond James believes to be reliable, but their accuracy cannot be guaranteed. This podcast is for information purposes only and is not construed as an offer or solicitation for the sale or purchase of securities. Investors considering any investment should consult with their investment advisor to ensure that it is suitable for the investor's circumstances and risk tolerance before making any investment decision. Past performance is no guarantee of future results. Information provided in this podcast is general in nature and should not be construed as providing legal, accounting, and/or tax advice. Should viewers have any specific questions or issues in these areas, please consult your legal, tax, and/or accounting advisor. Raymond James Ltd. is a member of the Canadian Investor Protection Fund. Raymond James USA Ltd. is a member of FINRA and SIPC. Raymond James Ltd and Raymond James USA Ltd financial advisors may only transact businesses in provinces and/or states where they're registered.